Hello, everybody, and welcome to my video, an update on Datadog's Q3. So, what's not to love about Datadog's Q3? The business is doing amazing. Third quarter growth, year over year revenue growth was 61%, a growth of 69% of customers with more than $100,000 in annual recurring revenue. These are customers that will consistently keep spending. Announced 18 new products. It's still free cash flow positive, so we don't have to worry about anything related to bankruptcy. They have $1.8 billion in cash. The dollar-based retention rate is still coming in at 130%, which means that customers spend 130% more each year as Datadog adds new products. So think about that, right? That means we have pretty much guaranteed, or as close to guaranteed as we can, dollar growth, revenue growth in the future. And then importantly, the gross margin is unchanged. The gross margin is still 79%, and for a total gross profit of 343 million. So the business is doing really well. It's perfectly on track, and it's an essential business for the cloud, for cloud monitoring. It is the leader in that field. And yet it's down 11% because this market just does not follow fundamentals. Fundamentals don't matter. Only the Fed, only interest rates, and preconception of what a stock is. That's the only thing what matters now. The only thing that I could explain why the stock is down a little bit is because they issued very conservative guidance of 38% year over year for Q3. That's what it would be. But if you took the total year, even at the end of 2022, you'll still be very close to 70% revenue growth. So of course, they're going to give conservative guidance. Why wouldn't you give conservative guidance? I mean, you have companies that have stellar companies. Look at today. All of the cloud stocks, many stellar revenue growth, amazing results, and they're all down. Everything's down. So why wouldn't you give conservative guidance and set up the market for a positive surprise next time? I think that's what they do. I actually don't see growth slowing down for a company like Datadog, because the growth of Datadog is inherently linked to the growth of the cloud. This is what I say, right? If the cloud thrives, Datadog is going to thrive. Period. It is the leader in monitoring your cloud. It's the dashboard of modern cloud infrastructure. And they have built-in network effects. Who is going to develop a new Datadog that integrates 600, 700 different apps? Who's going to start this from scratch? They've been doing it from 2010. They're the leader. They have some of the best ranking. They are the benchmark in this market. So as the cloud grows, Datadog will grow, and we may see a little bit of a slowdown in the cloud, but you're still going to have this 40 to 50% long-term growth that I love and look for in most cloud companies right now. Like, these are amazing companies. These business models, these cloud business models, are just superior business models. They are money minting machine. That is the future of business. The future of business is cloud. Companies are getting more and more automated. Companies are looking more and more like automated algorithms, and Datadog is essential to monitoring all of your cloud additions, and companies have to adopt that. They just have to adopt it. It is the trend of computing right now. So look at this chart. This chart is from Datadog's annual report, and as you can see, we are still very early on. We are still only 10% of IT total spent on cloud, right? And it's expected to double until 2026. So the growth of cloud is just a major secular trend, which is why I love so many of these cloud stocks. It's a secular trend. It's like right now the market is very short-term oriented, only cares about interest rates going up. Doesn't change the fact that companies are going to go to the cloud because they save money in the cloud. The cloud is just a better way a more flexible, more agile way to run a business. So it's a bet on the cloud. Cloud is the future. Companies are outsourcing their IT. Why would you choose the cloud? Why would companies choose the cloud? Well, because building products on premise is always more expensive. There is this famous story about how the cloud really became this big with Amazon, right? Amazon built giant servers to be able to handle holiday demand and holiday sales on its website. And then they had excess capacity and created infrastructure as a service, created Amazon Web Services. No company wants to overbuild their cloud infrastructure. They want to be able to rent it. Just like you wouldn't build a power plant, you just have an electric bill. Companies don't want to build major data centers. They don't want to build a major IT stack. They want them to be able to rent it. To rent it. That way they can save costs because you link your IT expense to your revenue. It is a function of your revenue. The more you sell, the more you use these cloud products, the more you get charged. So you're inherently agile, which is what I love. And also, so many companies wasted so much of their attention focusing on side IT projects, which now they don't have to focus on the cloud. Now companies are free to focus on their main source of competitive advantage. So I cannot emphasize enough that the cloud is the future of business. And by investing in a company like Datadog, you are investing in a cloud application agnostic app, which you don't have to make a bet on which app is going to thrive because you're betting on the monitoring app of it all, which is what I love about Datadog. It's about monitoring. So doesn't really matter which cloud stocks or cloud companies, which SaaS company thrives, it doesn't really matter. It's just monitoring that you're betting on. And monitoring is a very promising sector because nobody wants to have to log in and monitor 100, 200 apps as one. People want a dashboard, just like you have a dashboard on your car. Corporations want a dashboard for their IT cloud infrastructure, and they want to look really easily and solve issues really easily within one unified dashboard. And that dashboard is Datadog, or at least that is the leader in this market. So it's not surprising that a stock like Datadog has been doing so well. And I want to emphasize again that the crash that we're seeing right now, to me, has nothing to do with the performance of Datadog. The crash that we've seen right now in these SaaS companies, these SaaS stocks, and especially Datadog, this crash has everything to do with the Powell, what I call the Powell-induced crash. Powell raising interest rates. But raising interest rates just creates a short-term horizon in your investors. It doesn't change the fact that there is fundamental underlying productivity enhancing innovation in these cloud companies, and Datadog being one of my favorites. And actually, when you look at Datadog, ever since they went public, before the current interest rate rising spree that we're on, before that, the stock was growing at 90% a year. Now, some may say it's unsustainable. But let's even go after the quickest, fastest, highest magnitude rate hike spree that we've had in history. Even after that, and the stock is down so much, even after that, we're still at 25% a year over the past 3 years and 3 months. So it's still a 25% return, which is still an outstanding return. And this stock will bounce back as soon as the Fed pivots. I believe this stock will bounce back. Not investment advice, but I think it will bounce back. So I'm very happy with that. I think they've had a great quarter. But let me take it even further, and this is one of my main observations as to why really valuation really doesn't matter. Look at a company like Datadog. They've had only 8 rounds of VC funding. VCs invested in Datadog $148 million. And the median worth for the past 2 years was $47 billion. Over 12 years, VCs have achieved an average annual return of 62% per year. Now, of course, the growth will normalize. It may not grow this fast, for another 10 years. I don't think that. It may normalize. But will it grow? Will we get another few years of high growth in the 40 and 50%? Probably. And as this company matures, as this company gets into much higher market cap, maybe we can expect growth in the 20s or 30%. But this company is riding a tremendous wave. It's riding the wave of cloud computing. It is the next stage of computing. Corporations are all moving to the cloud, and if they don't move to the cloud, they will not survive. Corporations have to move to the cloud. Just like at the turn of the 20th century, corporations had to adopt electricity. It is as simple as that. And when you see companies that have been able to achieve such valuations so fast, it's tough to believe that the momentum is not going to continue. They have not captured anywhere near the total addressable market that this company could be. So again, companies have a lot of inertia. This is a company that is very, very dominant, that has network effect protecting it, that has inertia, that has a founder-led management team, and that has a very valuable product that saves cost for IT developers and DevOps. So I really believe in this company. Quarter was great. I would expect nothing more. The stock is down because of macro reasons, and I'm very happy to keep buying the stock. And I believe the stock will do much better than the indexes and much better than the growth in the money supply and the money stock, especially as the Fed pivots. So, not investment advice. Thank you so much for watching my short update on Datadog's Q3, and good luck with your investing journeys. Thank you.